One of the biggest mistakes that anybody could ever make is how they go about finding financing. Now I have a property that's been 100% financed by the banking industry that I get to give them back less money than what I borrowed.
Now your deal just became so bankable from a private lender standpoint that private lenders are going to have a hard time looking past your deal to look at another deal that doesn't have that exit already figured out.
Do you see why the banking industry says the interest rate is the most valuable part of the deal? Because it locks you into them as their slave to continue to keep paying them interest.
What's going on, everybody? Welcome back to Money School Podcast. I am your host, Chris Naugle, and today's episode is epic and timely because what we're going to talk about today, my guest has been doing this for over 20 years. He's literally carved a niche in the real estate lending space. He is the guy that literally gets deals bankable when they are unbankable. He is the guy that can get you financing on your investment deals. And he is also the guy that is well known in this industry to be able to get the deals done when nobody else can. And I'll tell you this, right now, this might be one of the most important podcasts you listen to if you're a real estate investor because banks are shutting down. It is getting harder to get money for your long-term deals. There's tons of people that are coming into the space, buying properties with private money or hard money, and they fail to have an exit strategy. And when I say exit strategy, I mean takeout financing to pay off the hard money, the expensive money with traditional financing. My guest, Aaron Chapman, has the answers. We're going to get into this, how he does what he does, why he does what he does, and how he is working with us and privatemoneyclub.com to literally change the game for real estate investors. Welcome to the show, Aaron.
Wow, brother, that's a hell of an intro. I think you only took two breaths during that entire thing, man. That's awesome. Thank you.
For sure. So I know you've been in this space for over 20 years, and I know you've been through multiple cycles in the markets. You've seen the good times. You've seen 2008, which is about as bad as it got for real estate investors during the Great Recession. And you're seeing what's coming and where we're at right now. So what are some of the most important things that you could tell to real estate investors right now that are either struggling or that are going to be struggling when they really try to get this exit financing?
So you're right. Been at this since 1997. You see a lot of cycles in that whole world with the dot-com bubbles and the other recessions that we experienced, and then of course with the 2008, and then you've got COVID and all these things that we went through. And I think one of the biggest mistakes that anybody could ever make is how they go about finding financing. There's a lot of noise out there, an extreme amount of noise with respect to, do you want to shop the lowest rate or shop the people who are most visible? There's a lot of guys out there that have been in it only the last 5-10 years. They don't know enough about what's happening in the markets to be able to properly educate you. People look at lenders as a commodity. Well, who do I just go to and get the deal done? Being able to get a deal done or quote a deal or be able to have decent rates and fees, that's just the barrier to entry. It's the experience that people need to be able to coach you through the process. This is a very, very intricate thing. And I discovered early on in my career that the real estate investor is very, very overlooked and almost villainized by the banking world. I've stood in Congress and the Senate and talked to members about real estate investors and how they're being villainized by the way the regulators are seeing them, instead of seeing them as the ones who are fulfilling their obligation to give low income housing. Because that's where a lot of people stand on the floor of the Senate and the House, and they pound their chest about how we're going to fix low income housing, but they fail to see that the real estate investor is the one doing it for them. And what's interesting is I had Maxine Waters, I don't know if it was her chief of staff or one of her main representatives, grab me and said, we got to talk, and handed me her card in 2019. So I'm like, I'm coming back when you sit down, and then COVID happened. I'd never been back because with everything that happened then, they locked down DC, they put up fences. You can't get to any of these guys anymore, but they saw the point. I've been involved with people that have changed laws that were being presented that were going to affect the mom and pop type of real estate investors. They were going to help the big guys, going to help the hedge funds. The other thing I think people are really looking at incorrectly today is we're heading into a new 2008. That's what the mainstream is telling you. They're screaming, be aware, we're going to another 2008, be cautious. Well, who owns Mainstream? Have we not figured out that when Mainstream is preaching something, it's benefiting somebody else? And sure as hell ain't you and me. It's benefiting the people who own it. So when we have seen that the hedge funds have been buying 30, 40, 50% of the available single family housing, and people are now taking a step back, now is the time the real estate investors should lean in. And I know a lot of them are. They're leaning in, but they're leaning in with the harder money and the private capital, which is a great way to get into it. But they jump into deals thinking, okay, I need to go shopping for the right deal first. They look at the right investment property, they find it because that's where their mind is focused, but they haven't looked at the finance piece. And now they've got a contract in place. The clock is ticking. I've got to close. You get that private money or that hard money, you close that deal, and then it's like, now what? Now, it's great if you're a flipper. And I think that flippers, we have a great place for wholesalers, flippers, keep moving that money. But how many of those guys, I bet thousands of them that have looked back on their career as a flipper and like, there's probably about 50, 60 houses I should have kept, but I didn't know how to.
I am one of them.
So, and can you, how many would you say that you should have really, you looked at, you're like, man, I really missed the boat on that?
Oh, there's 274 flips that we did during our little hiatus of doing that. And I would easily say there is no less than 40 of them that literally I can't believe I sold because they would have been so valuable, such great rentals, but I flipped them, I sold them.
And I have some myself. They were monsters. I flipped them for 100 and some thousand bucks. That thing is worth $500,000
Oh,
today.
absolutely.
It was just like 15 years ago, right? So, it would have been hard to hold that asset and let it just continue to compound. Problem is that most investors are so busy looking at, okay, how much am I buying for, but how much is it worth today? How much can I flip it for? That's that Kiyosaki thought process. You make money on the buy. Unfortunately, most people don't realize that there's so many different ways to make money on the buy. One of the easiest ways to make money on the buy is by getting it leveraged for a significant amount. Like I said, even if you're putting 20% down, you're leveraging 80%. You're only investing 20. And then as that property gets paid down by your tenant, you're literally seeing a 13% growth on that 20% you invested. If it's appreciating a minimum of 2.5%, that's equivalent to another 12 to 13% on the 20% you invested. You're making well over 25% on your money just by somebody paying off the note and the home appreciating on an annual basis.
Let me give you a real example of that. Like you're absolutely correct, folks. Everything he just said, pay attention to that. So interesting story. So many years ago, I think 2014, I bought a property at 471 Hawley in this little town that I grew up in called Lockport, New York. I bought this house for $21,000.
Wow.
I know you don't have relevance of the area, but we'll get to that in a second. That was cheap. It needed work. We renovated it, probably put 30 grand into it. And then we did this with all private money. Okay. So we got that. The house is worth significantly more. I took it to the bank and I refinanced the property, pulled all of my money out plus additional cash. Now, what I did is I rented that property out. I got $1,000 a month from 2014 until a month and a half ago when I evicted the same tenant because he stopped paying. So just think about that. That's a long time. Aaron, you know exactly what that means. I was paying that principal down quite a bit. But you see, I even went one step further. What I actually did is I got to a point where I had the capital in my private banking system that I bought the bank out and I made the exact same payments back to my banking system. So I controlled the mortgage. I got all that interest back to myself. And now here we are. I'm renovating the house. I've got a $35,000 renovation. It's pretty light, just skimming, painting, flooring, bathroom, kitchen. And that house, now I'm going to literally list it and probably sell it for $130,000. Maybe I get 120 net. Just do the math on that, Aaron. It's exactly it's what you just said. It's not even a highly appreciated property compared to some of them, but like, just think about that. That property owed me nothing. I got all the money back. Matter of fact, I didn't even bleed the interest for the last 2 years because I was paying it back to myself. And now what I sell it for, all that is literally true net profit. And I benefited from all the taxes over the period, the tax deductions over time.
It's really, really, it's pretty amazing when you're patient enough to see the outcome. And that's the problem. Most people are not patient enough to see the outcome. We're not seeing that. In fact, you point out something else that you're starting to see where a lot of people are walking away from these opportunities because they're looking at they're being told to go into other assets. If you look at what the markets do, we had the crash of the stock market, right? Most of the time, you'll see the stock market crashes, the bonds benefit, interest rates get better. That didn't happen these last couple of months. It didn't happen that way. But what did go up? Gold. Other hard assets went up significantly. But what's interesting is people didn't equate, hey, the desire for hard assets didn't equate over to real estate like it should have. Guys, that's a hard asset. A hard asset better than gold. Why is that a hard asset better than gold? Because I can't take gold and I can't rent it to somebody to pay for it for me. You have to wait and let the market grow. You can't have gold be paid for by somebody else, and you can't use the appreciation of the offset, and you can't write it off on your taxes. Real estate has so many different angles to it. One of the things that you talked about was be able to finance it yourself, and I agree with you. You got your ability to do your own bank, great.
Most people don't. I just want to throw that one in there.
Yeah. Well, I like to use my own bank a little bit differently. I used to like to use it on the acquisition side, but when it comes to long-term leverage, I'm not one that'll use my bank to pay off long-term leverage. I have a different philosophy on that, and there's a reason why. Now, we're going to get into a little bit of inflation conversation. What do you know the current rate of inflation to be?
About 3.4.
Now, would you believe? Okay, so that's what
it is in 3.4. I'm just trying to guess as to what they're saying. It is. It's more like 8 or 9%.
100%, because you're saying everybody says, well, the Fed says it's 3.4, but
they exclude the things that are really inflationary.
They exclude what you really spend money on a day-to-day basis. They look at durable goods and things they can manipulate with monetary policy. It's an index, their index, right? It's just like saying, well, we've got the NASDAQ, the NYSE, and the Dow. They're not the same. They're all stocks, but they move differently because they have different things in them. The same thing with the personal consumption expenditures index and the CPI. Both of those different indexes, different things measured, they move differently. So when it comes to money, I've got this. I've got an 1888 gold piece. I don't know if you can see that.
Yep.
Minted in 1888. What's interesting about this, if you look on the back, it's minted for $20. You can't see that because it's really hard to see on the camera. There's a $20 gold piece, 1 ounce of gold. Is it really worth this, Chris?
No.
No, it's not. What's interesting about this, today, just in its weight is $3,500. In its minting, it's almost $7,000 for this little piece right here. This, perceivably $20. What's interesting about this $20 and this $20 is in the early 1900s, you can walk into a department store, get a hand-tailored suit, a hat, a shirt, a tie, a belt, a pair of socks, and a pair of shoes with that.
Yep.
I can't get my socks with this.
Isn't that crazy?
Interesting.
And that $20 is lost. If you go back to 1913 at the advent of the Fed, that dollar or that $20 bill has lost roughly 90, if I'm not mistaken, I'm gonna get this off a little bit, 90 to 95% of its purchasing power during that period of time.
Yep. Now let's go back 30 years. We're talking about a 30-year window here. And there's a reason why I want to go into the currency thing and the personal bank. 30 years ago, it's actually 31 now, 1994, I walked in the very first Taco Bell I've ever walked into. It was in Moses Lake, Washington. I bought 2 crunchy tacos, 2 bean burritos, and a drink for $1.99. Do you know what that costs today?
I don't, but way more than $1.99.
It's $14. It's $13.90. Yes. Now, did the burritos and the tacos get bigger? No. Did they get healthier? They sure as hell did not. They're probably way healthier back then. It's the dollar has become worth that much less. So the point behind me saying all this, it's not that the clothing has become more expensive. It's not that the tacos have become more expensive. It's not that the gold is worth more. It's because this is worth that much less. So when we finance something for 30 years, I always tell everybody 30 years, get the 30 year, get the 30 year, get the 30 year, because when you're paying it back to the bank, you're giving them actually less and less and less every single month because the dollar's worth less and less and less. So let's say we got a $200,000 house that you're going to buy as a real estate investor, and you financed $160,000 of it because the 80% of the deal. And you paid that 80% of somebody else's money, your tenant's money, for 30 years. That's equivalent to $402,000. And the inner Dave Ramsey in your skull is screaming, pay extra payments, pay that off, do a 15-year note, don't pay all that interest. But what he's not screaming is that this is losing value. So when you recalculate it every single month for 360 months, you paid $154,000. You borrowed $160, gave the banks $154. So when I look at the whole thought process of, okay, can I take my personal bank money and pay this off and collect the interest? I'd rather leave the bank's money, they're losing money, and take mine to go buy more assets. And how do I buy those assets? So we're talking about people here within this organization right now. The people who are listening to us today, they're thinking, okay, yes, I like to buy and I like to flip, but man, how do I hold those assets for long term? And if you're thinking that, we need to talk before you go out there and look at them. So here's how I do this. When I'm looking at these different assets, and if I want to flip something, I'll just get it, purchase it, rehab it, flip it, right? But if we're going to buy it and hold it, I do the exact same acquisition. I'll have an LLC in the area that will buy the property, and I'll take ownership of it. But when I buy it with that property, in that area, and I've got the capital in my private bank, my personal bank, I have a separate LLC that holds that capital. So let's say I live in Arizona. I have an Arizona LLC that holds the capital, but I'm going to buy something in Tennessee. I create a new Tennessee LLC to buy the property. It goes in as on contract as the buyer. I'm backing it up as the sole member of the LLC. Now, when I go to closing, my Arizona LLC wires the money to title with a promissory note and a deed of trust. And now my Tennessee LLC owes my Arizona LLC the money. And when it comes time when the rehab is done, we're fixed up and ready to go, I've already started a loan in the background for myself with bank money as the property is being rehabbed. As soon as that rehab or construction is complete, we send an appraiser in there, and I now refinance that, pay off my LLC loan to Arizona LLC. So Tennessee LLC gets a new loan, 30 years fixed, that pays off my Arizona LLC. All the money's back in my hands, and now I have a property that's been 100% financed by the banking industry that I get to give them back less money than what I borrowed.
Oh, and I know we've talked about this, but this audience hasn't heard this, and this is perfect. If any of you are not in privatemoneyclub.com, get in there. As of yesterday, there was 8,500 members in there. The majority of them, at least 50 to 60% of them, are lenders, okay? And they are private lenders. So, Aaron, I lend a lot of money in there, and I'm speaking first person here. I'm in Private Money Club, and I'm in there all the time looking at deals. And I come across a deal, and in the deal description, it says already approved for exit financing for this BRRRR. They're going to buy it, rehab it, rent it, and then refinance it. As a lender, I'm going to look at that and be like, I love this. Not only am I in first lien position going into this, so I'm protected for my initial phase, but they've got this deal pre-approved or conditionally pre-approved for the exit financing before they even started with the deal. As a lender, that's the deal I'm going to lend on, because that person took the extra initiative to go out there and do the underwriting, get it the conditional pre-approval, so that now I know I'm getting my money back when that deal is done. That is the highest position a borrower probably could ever be in when they're trying to raise money. I would bet if they position that right on Private Money Club or any other site trying to raise money, they're going to get financed. They're going to get that private money to buy that deal almost every single time. No ifs, ands, or buts. Matter of fact, they might even get people arguing and fighting over the deal. I know we talked about this, but that is exactly what you're going to start doing inside Private Money Club.
That's what I've been doing for a lot of hard money lenders across the country. And think about this, guys, from the perspective of the hard money lender, right? You as the individual that's got a deal that you want to present, whether it be on Private Money Club or any other hard money lender. Hard money lenders are lenders. They aren't into owning assets. It's amazing how many people come to me with like, it's such a great deal. It's 60% loan to value and nobody's lending it to me. They say, because they know it's a good deal, but they don't have faith in you. You're going to pay them back.
Absolutely. 100%. It's not the deal.
Yeah, some people are like, but it's a great house. I mean, they don't want to own the house. They want their money back. They want their points up front. They want their interest paid. They want to get their money back, and they want to do it again. They don't want to own your damn house. Otherwise, they would be financing houses. They'd be buying houses.
If us lenders wanted to be in the real estate game, clearly we have the capital. We'd be out buying real estate. The reason we're lending is because something happened where we just don't want to own the assets. I just got sick and tired of dealing with tenants. I got sick and tired of building inspectors and all the nonsense that came along with owning the assets. I just wanted to lend because I wanted the easy street.
That's a really good observation. And the thing is, guys, just because a lot of us like to have be lenders, Chris just told you about, he owns real estate too. I own real estate. I have real estate in 6 states. I'm involved in over 200 doors, but I still lend because I like the lending capability. I don't have the bandwidth or the thinking to look at all of these different damn markets, keep trying to analyze deals. I'd rather analyze something from the lender's position. Now, if you want to be able to, I recommend you build up your real estate portfolio and start working on building up a lending portfolio. But if you want to do the real estate portfolio, you got to call somebody like myself. No, not somebody like, you got to call me, damn it, and my team, because this is what we do. We've been doing this for 20 plus years. I have members of my team that have been doing this since the 80s, that what they do is they help you get set up to where you know exactly what you have to do. So when you present that deal to the private money lender, they can underwrite it, but they also can underwrite it knowing that we have underwritten, and that when you go in to buy that property, you know, bankers who've been doing real estate investment lending for 27 years have underwritten your deal in advance, saying, yes, I think that what you're buying here is a good asset, will have a good outcome. Multiple different people collectively ensuring your success. So then when you present that, you say, hey, I've already got Aaron Chat and his team ready to fund it as soon as the rehab is complete. So you go in with them, you present that, and we will guide you through every bit of it. We'll guide you through the setting up of the LLC to acquire it. We'll guide you through the pre-qualification, what to send over to your private money lender, the whole works. So that way you don't have to try and figure this out on your own. And as soon as that closing starts from that new property that you just bought, we start the refinance the day after. And we start working on the paperwork with you. So while they're rehabbing it, we're working on your loan. The construction is being done in tandem. And as soon as that property is done, I want to send an appraiser in there the day after it's complete. Now you look at the BRRRR strategy, they want to say buy, rehab, rent, refinance, repeat. I flip the rent and the refinance around. You want the refinance going immediately. You want the appraiser to see it before a tenant moves in. Chris, have you ever done an amazing rehab and then you run into a tenant who moves in really shitty and it looks like they just exploded in the house?
Oh, yes.
You don't want the appraiser to see that. They're going to have to use their imagination. I'll just tell you, appraisers' imaginations suck. So you want them to see it when it's at its best. It just got finished rehab. They cleaned it up. They spit polished it. Appraiser looks at it, gives you the best possible valuation so we can give you the highest possible refinance, and you leave the least amount of money in there so you can go do it again and again and again. Can you imagine? I had a client of mine came to me with $75,000. He wanted to start buying and doing BRRRRs on houses. On his 5th house, he left like 12 grand in the deal. That was it. But his $75,000 was recycled 5 times, and he only left 12 grand in the last deal. He bought 5 houses for 12 grand, and they were all fully rehabbed, fully tenanted, completely cash flowing. How often does that happen in a person's life?
Not very many.
You know, and so that's where we come from, such a long history doing this. If we're telling you that, yeah, you may not want to look at this real quick, or you may want to really start asking these questions. I don't tell you not to do something. I'll tell you what questions to ask. I cannot sacrifice your success for one deal. You know, the one thing that I do know about the lending industry out there, the average person in my space is doing 1 to 2 transactions a month. We're doing 30, 40, 50 transactions a month. So if the average person is doing 2 and you contact him and you're working on the deal and they say, hey, and you're running into problems, you're not sure if you should buy this, you call them to get some advice. I want a third party's eyes on this. What do you think he's going to tell you if you're 50% of his income that month? Any damn thing he can to get you to close that deal.
I was going to say anything. Anything he has to.
He needs to put bread his table. He's got kids. Now, God bless him for kids, and I know he's got to do that. But if you're calling me and you're 1/50th of my income, it doesn't matter whether you close or not, whether or not I can bread my table. I'm not incentivized because of my situation at home to force you to close. We're going to talk it through. I need you to not just be successful on 1. I need you on 5, 7, 9. Because if you don't get to property number 12, we haven't done anything significant. And until we get to 12, we are focused on what makes you successful. Well, and still after 12. I mean, but 12, you'll probably have figured out a lot of this on your own by that time to really be able to hone in on things.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
Love that. And folks, we're going to put Aaron's link in the description. So if any of you are interested in talking to Aaron's team about your exit strategy, don't start with Aaron when you're ready for the financing. Start at the beginning of it, especially for all of you private money club members that are on there as borrowers. Like, what it's coming soon. It's not there yet, but what you need to do is get a hold of Aaron, get that started, get that exit financing, put it in your description that, hey, you're working on that or you've got that approved, because now your deal just became so bankable from a private lender standpoint that private lenders are going to have a hard time looking past your deal to look at another deal that doesn't have that exit already figured out. It's almost just like foolproofing the deal. So we're going to put that link up in the description. Make sure you check it out, get with his team. Even if you're just trying to learn a little bit more about like the things you need to go through those steps, just get started. So Aaron, where do you want to go from here? I know you've worked with a whole bunch of real estate investors. And I know banks in the industry has a flavor of the month. Yeah, probably not, but they have things that they like, things that they don't. We keep hearing DSCR all over. Can you explain what DSCR is for the audience, but then just explain kind of what is it that the industry is right now favoring and what do they not like?
So there's still a lot of favoring in the conventional world. And that's where I really probably did more in the lending, real estate investment space in the conventional world than anything else, because nobody wanted to lend conventionally to the real estate investor at one point. In fact, I was threatened more times than not by the banking industry that the people I was working with, like, we don't like all these deals coming in, until they start seeing, and it took time, that these were actually the best part of their portfolio. It actually took a Fannie and Freddie, I couldn't remember, I think both of them came into our company in 2016 and started auditing every file that was a real estate investor loan. And I was going through all kinds of hell, and I was being taken to the airport by the president of the company. And I had a question. I said, you guys are really well known in this firm for first-time homebuyer stuff. They said, yes, we are. I said, now, isn't the value of a portfolio the quality of the payment history on a deal? Like, how many deals have lates or default? He goes, yeah. I said, what percentage of your first-time homebuyers have late payments in the first year? He goes, oh, that's easily 10+%. Like, what percentage of my deals that you guys are auditing the hell out of because they're risky have a late payment in the first year? He goes, we haven't even looked. So they went back and looked at 1,300 transactions. What percentage do you think had a delinquency?
1?
2 properties. Out of 1,300, only 2 people had a late payment. One of them was because they sent the damn statement, the mortgage statement, to the house that was bought, the new investment property, not the person's house. So really, only one person had a late payment. They started actually looking at that more and started discovering the real estate investor is a very, very safe bet, and it changed the direction. Now, the direction got changed because I was going through hell and I had to ask questions. So what we're starting to find is the people that understand the real estate investor are starting to open up a little bit more. Now we have people targeting that DSCR loan. Now, what is DSCR? Debt service coverage ratio. Now, the tough part about real estate investing when you're talking about conventional is you have to qualify with your income. They look at your tax returns, your pay stubs, your W-2s, your K-1s, your 1099s. They're putting you through hell, and it's miserable. If you have multiple businesses, it's the worst thing in the world to have to do. I hate doing it, and I know how to streamline it. So you go to the debt service coverage ratio deal, and that just says, hey, is the property going to pay for itself or not? So instead of looking at you as your ability to pay it, let's look at the property's ability to pay it. So what that means is if you've got a property that has, say, $1,000 a month payment between the principal, interest, taxes, and insurance, can you get at least $1,000 a month rent? If you can, that's a 1 DSCR, 1% DSCR. So it's 1-to-1. If it's, say, $1,200, that's a 1.2 or thereabouts. The higher that ratio goes, the better your interest rate or terms get. So it's like another underwrite for you as the real estate investor. Will this pay for itself or not? And they're going to go off of what your lease is and what the appraiser says the market rents are. So you have multiple different ways of looking at it to say, yes, this thing will pay for itself. We trust you, Mr. Real Estate Investor, that you're going to take the rents and make the payment. That's what they're saying. As long as your credit score is above 700, 780 is still the premium credit score. So we're going to look at your credit. And why? Because that's how we know whether or not you're trustworthy or not to repay your bills. And then we can finance you to your LLC. That's the sexiest part of it. You can create a brand new LLC. I do it during the process of the loan because sometimes I create the LLC to match the address for accounting purposes and making sense of things. So I can create it After I go into contract and that new LLC goes on the loan and the loan is to the LLC, not to me, and it doesn't appear on my credit. So what does that mean? You, Mr. Real Estate Investor or Mrs. Real Estate Investor, can get unlimited number of properties financed for 30 years. And we just talked about why 30 years is important, because you're never paying back what you borrowed when you get 30 years, and the interest rate really doesn't matter at that point. The rates matter when you have to keep refinancing a commercial loan every 3 to 5 years, every 5 to 7 years. Most of your DSCR loans out there are short-term loans. They'll do a 5-year fixed with a 10-year call on a 30-year amortization. What does that mean? It means the interest rate's fixed for 3 to 5 years, because I see there's two different options out there based upon whatever index it is, but you have to pay it off in 10 years so that it's due and payable, but you're paying the payment as if it was stretched over 30. It's confusing, and that's common, very common. We are a flat 30 years fixed with my firm, that every transaction you get, it's locked in for 30 years, the same interest rate for 30 years, and it's that declining payment we just talked about that you'll never pay back what you borrowed.
Wow. Awesome.
Now, the drawbacks on it, they want to have a 5-year prepay, because they got to get money on this. We're asking, think about this. You're asking a side of Wall Street to invest in your business. They are allowed to make money off of the investment, and they don't make a return until they collect interest. Because they're talking about, if you go to the private money guys, we're charging what, 3, 4, 5 points up front. They're making most of their money on the funding, that points up front. We don't get to do that. Sure, there might be points up front, but that's just to pay administrative fees. Think about all the people involved. You got the ones who have to originate it, they have to process it, they have to fund it, they have to securitize it, they have to audit it, they have to set it up for servicing. That costs a lot of money. That's about 4 points to do. So they're in the hole when they fund your deal. No matter how much you get charged, they are in the hole when they fund it. They've got to collect that interest. So they're going to do a 5-year prepay if they can. So that way they can guarantee to collect some interest, at least make a profit off of you before you get flipped into something else. Now, if it's a 30-year fix, you're making the profit all the time. So never walk away from those things. I'll take the 5-year prepay, because if I'm buying a property and I'm going to finance it for that long, I'm going to be pretty certain it's one I'm going to keep reasonably rented the entire time I own it, and I can raise rents and it will appreciate. If you can't do that, flip the damn thing before you get done with it. Don't hold it. And people say, well, what if the rates go down in the 5 years? Who cares? We just illustrated to you that the rates don't matter. Let me show you something that people get caught up into. There has been a prevailing thought process. If the rates drop 1%, you should refinance, right? Well, what's the average person refinance their primary residence? How often? Do you know, Chris?
Every 5 to 7 years.
Every 5 to 7 years, if not more often than that. The only reason that's stretched out a little bit because so many people got 2% interest rates, right? But before that, it was every 4 to 6 years, so averaging 5 years. What does the first 5 years of a 30-year fixed mortgage look like on the amortization table?
All interest.
All interest.
85%.
You're paying almost all the interest on the front end. So I'll tell you about a client of mine came to me. He had a $120,000 mortgage on his house. His banker had retired. His dad had passed. His dad and his banker always told him, if the rates drop at least 1%, you refinance. So he wanted to refinance. I said, how much cash do you want? He goes, none. I just want to drop the payment. I'm like, are you sure you don't want to take some cash out? You can reinvest it here. He goes, no. I've always been told to do this. I couldn't convince him otherwise. So he had gone 48 months worth of payments. He had paid almost $38,000 in payments, but the balance only dropped by about $6,200. Paid $38,000, guys, over 4 years, but the balance dropped $6,200. When we got done with that refinance, he had just under just right over $6,000 in costs. Where do you think he put the costs? On top of the loan. By the time he was done with this refinance, he was within $102 of the original balance, but it paid $38,000 in payments. Who's losing?
And then he just restarted the clock again. So now he's back to the top of the amortization schedule, paying the highest amount of interest he's ever going to pay on that mortgage.
100%. So if he continued that same practice for 20 years, he would have paid $180,000 and still retained his $120,000 mortgage. Do you see why the banking industry says the interest rate is the most valuable part of the deal? Because it locks you into them as their slave to continue to keep paying them interest. Don't do that crap. Lock it in, write it out. If you do refinance, it's to pull cash to reinvest.
It's funny, Aaron, in my school of thought, what I've always been taught was that would be the only time that you ever refinance a property is to take the cash out so that you can then go buy more property or buy more, invest it and make a better return, because that's what makes that difference. But outside of that, like, I think maybe there is a different school of thought out there, like you just said, where people are taking mortgages out because they just think that 1% savings or whatever that savings is going to pencil, but they're not doing the math. Because if they did, they would clearly see that they are literally burying themselves every time they do that.
The thing is, they've never been taught the math. So, Chris, you are one of the lucky people that in your earlier part of your career and the early part of your life, you happen to be in the right places that heard those things. I didn't hear that growing up. I grew up on a cattle ranch. I was working. I was much amongst a bunch of blue collar guys when I got into heavy equipment and driving truck and working in the mines. They didn't get that math. They were never taught that math. They're taught the math that was handed down by those who benefit from that math, not from math that would benefit them. You found yourself in spaces where they taught you correctly. Anybody who's listening to this podcast, guys, we're teaching you correctly. Listen to what we're saying. This is not for us to get rich, it's to get you rich, and we will become wealthy as a result. The thing about business has been misinterpreted or misaligned for so long. People think business is like war. Somebody has to win. No, that's not how war operates. War is who can sustain the most devastation the longest. That's who's the winner in war. That's not a way to win in business. I have seen guys that approach business like war that keep changing their business because they keep getting hurt themselves. We're here to lift everybody up. It's possible for every single one of us who's on this conversation, that's listening to it, listening to recording, to win all at the exact same damn time. Everybody. We just all have to work together to do that and embrace the proper thinking. The proper thinking has been taken away from the mainstream. The mainstream is putting stuff out there to keep you a slave to the system, period.
Well, I'll tell you one of the biggest things, and we talked about this offline, that I've seen it firsthand, and I've seen it in just about all walks of life, that is literally probably keeping people trapped. I call it financial slavery, is because people have gotten themselves so busy. And I don't mean busy doing productive work, because that's productivity. And I think this country has seen a major decline in productivity from its workforce. But what we have done is become busier and busier and busier in our daily lives, our daily, things that we do, and largely because of technology. We are so busy being busy, paying attention to what everybody else is doing, watching social media, doing that. It's ingrained in everything we do, from personal to business. And then in our business world, whether you're W-2, 1099, an entrepreneur, doesn't matter. We're so busy there that literally it leaves very little time in the day to get out of the financial rat race that you're in. And you know what? The people at the top, the people that benefit from this, they know that. They know that the busier they keep you, the more they keep you distracted, the more you're just going to do the path of least resistance, which is the path they want you on. Put money into a 401k, max it out, keep doing all the things. Let the advisors manage your money. You don't need to be in control of your money. Keep putting money into the banks. Do this, do that. Have you ever just stopped and just started to think about why you do the things you do? And then have you ever done the math behind it? Because then logic is right out the window, because there is no logic. It is 100% emotional based decision making. And that's why people get stuck. That's why they feel trapped. That's why they're highly in debt. That's why the delinquency and soon the default rates on debts in this country, primarily credit cards, are out of control. You're seeing it in car loans. You're starting to see it a little bit in the mortgage realm. You're definitely seeing spikes in the credit card delinquencies, and that will translate to defaults as things materialize and get worse. So folks, like everything Aaron's telling you here is exactly what you need to be doing. It is the truth, but sometimes the truth hurts because it takes you learning something that is different than what you thought to be true. I think Will Rogers says it best. He said the biggest problem in America is not what people don't know. He said that the biggest problem in America is what people think that they know that just ain't so. How much does that ring true in your life? And how much of what Aaron just told you about mortgages defies what you thought you knew that just ain't so? That's the whole sum up. And that's why Private Money Club is getting better and better, and more people are coming onto it, because we're giving people the truth when it comes to money. And we're trying to solve two problems for the only two people that exist in this world. Number one, there are people with money. But make no two ways about it. No matter how much money they have a problem. And that is they want to make more. So how do we solve a person with money's problem? Well, go to the other side of the coin. The other group of people that need money. And why do they need money? Well, they need money to make more money. So if they need money and they have money and they both have a problem, all we did is created the matchmaking service, the dating site that brings them together to solve one another's problems. Each of them fulfills their problem by solving the other person's problem. And all we're trying to do with help of people like Aaron and his company is make this more efficient, bring more truth to this whole process, and stop helping people stop blowing money, wasting money on the things they were taught that they should not be doing. Once you get around this campfire, folks, things will start to change quick, real quick, because I know everybody that like is in real estate, the number one thing that I hear at all the masterminds that they're all having trouble with is finding money or finding exit transition money to get out of their hard money that is burying them because it's usually expensive from an interest rate standpoint. This is the path. Aaron is your solution, but don't wait till it's too late to start earlier. Aaron, anything you want to say on just that little rant I just did?
That last thing you just said about too late. A lot of times folks get caught up in the thing like, well, at my age, man, a 30-year fixed, I'll never pay that off. That's the whole point, everybody.
That is the whole point.
That's yeah, you're never supposed to pay it off anyway. I don't give a crap what your age is. And it is never too late. Late is perfect timing, just so you know. There's no such thing as too late. Because if you are stuck in this thought process, you could be 65, 70 years old listening to say, damn it, if I was only 20 years younger. But you probably have grandkids coming up. You need to change the direction of the generations that follow you. That's the thing that drives me the hardest, is what's going to happen to these kids and grandkids that I have. My kids can't get houses with what's going on right now with the income versus the cost. So the trust that I created, nobody else created it. I come from a blue collar background, buys those houses, leases them to people, the beneficiaries. We self-manage. We have self-warrantying it. I can help you with that whole structure, at least tell you how we did it, point you to the attorneys on my website. They'll help you with the same. But guys, it's never too freaking late. Change the direction of your posterity. Be a reason why there's a legacy. If you look up legacy, it talks about leaving money. You may not have that, but you can leave a thought process that's worth a hell of a lot more than money. Leave an education, leave them a direction, have them start moving that way. I do Zoom calls with families. They'll come on, they'll bring in 3 generations, and I'll have that conversation because I'm trying to help those kids that are in grade school right now start changing their thinking as to how they need to be doing stuff. And if you're going to hand that off to them, you don't want them to blow it on what's going to look good on their TikTok with their new Louis Vuitton bag. We don't want that crap. We need to change what they're going to do with what you leave them. And as meager as it might be, it could change things for 3 generations from now. And then you go out and get that painting commission so they can hang that above their mantle and know that's who changed it.
I love that. And right on that level, folks, I am so passionate about what he just said, because the biggest legacy we will all leave if you have children is how your children go through life and the knowledge that we leave. It's not the things that we buy and we leave them. It's not the car and the house. Most of the beneficiaries, most of our children, that's not what they want. But giving them the knowledge that we didn't have when we were growing up so that they can be more efficient, live a better fulfilled life, and be more financially responsible and financially secure, that is a legacy that will always top everything else. I'm so passionate that, literally, shameless plug, me and Hannah Kessler wrote a children's book recently. It's called The Companion. It is based in money, but it is not going to read that way. It is going to hit everybody differently. It is a phenomenal children's book, one that I would love to ask every one of you to grab, especially if you have children, but it's not going to just help your children. They're not going to just love the story. It's going to help you. If you ever remember growing up, The Giving Tree by Shel Silverstein or The Missing Piece, that book, I don't care who you are, that book meant something to you. And when you were read that from your parents as a child, it meant one thing. And when you got older and you were reading it to your children, it meant a completely different thing. Some of you probably cried when you read it to your kids as a parent because you understood a deeper meaning. This book, The Companion, is exactly the same. It is fun, but it teaches the lessons of giving, the lessons in the consequences of taking, and the power of loving. That book, I urge every one of you, grab a copy. You can grab it by going to companionbook.com. That's companionbook.com. And while you're at it, if you're really passionate about your children and teaching them the things that we never learned, listen to my TEDx talk, totally free. You can just search Rethink Money, a letter to my daughter. And that is the 6 laws of wealth told in parables in an actual letter that I wrote my daughter. So folks, legacy doesn't have to be the money, the things we leave behind. It's the knowledge we leave that we wished we had when we were young and when we were growing up. With that being said, Aaron, thank you so much for coming on. Thanks for all the hard work you're doing for the Private Money Club and changing the way that entire platform happens from an exit strategy. Is there anything you'd like to say before we end this podcast?
Nope, I appreciate you guys. I'll be back on. So when I get ready to launch the book that I've got come out, Red in Economics, which it's the thought process behind all these things. It's the changing of the mindset to go after these things like a silverback on Coke. That's the goal that I have to help people change their thinking. You've got Chris and I working together to change generations. And I appreciate you, Chris, for allowing me to come back on again. I can't wait to see you back the next time.
Oh, my pleasure. And thanks everybody for joining us for this episode of the Money School podcast. Make sure you check us out, leave us a like, and the most important thing, go out there and change the way you think about money. See you next time.